Are you looking for dividend stocks to generate some nice passive income and market-beating long-term returns? Let's get some insight from Peter Lynch. He's the incredible mutual fund manager who returned about 29% per year for his investors between 1977 and 1990, essentially transforming a $10,000 investment into about $280,000 over 13 years. Lynch is also the author of the New York Times bestseller, One Up on Wall Street. One of his famous quotes is, "Invest in what you know." So what do we know? We come into contact with many companies every day. For example, in the past week, you might have gotten a quick bite at Burger King, Tim Hortons, or Popeye's Louisiana Kitchen and noticed that the quick service restaurant was buzzing with people. This triggers you to do more research and realize that these franchises are actually all under the same company, Restaurant Brands. Just because a restaurant is full of people doesn't mean it's making money. Let's do a quick dive into Restaurant Brands to see how it's doing. At first glance, Restaurant Brands' debt levels may scare you. It has long-term debt of about $12 billion and is given an S&P credit rating of BB-, which indicates a speculative investment. However, Restaurant Brands is able to carry so much debt on its balance sheet because its cash flow generation is pretty stable and is a capital-light business. In the trailing 12 months, it generated $1.4 billion of operating cash flow, but capex was only $65 million, leaving it with tons of free cash flow, of which it paid out 66% for its dividend. Over the next 5 years, it only has to repay about $321 million of debt, which is easily covered by its cash flow. About 97% of its debt is low-cost, long-term debt with a current interest rate of less than 3.8%. However, keep at the back of your mind that if interest rates were to rise, it would weigh on the stock. Restaurant Brands stock's valuation is good, as it has corrected about 21% from its 2019 high and is trading at roughly 21 times cash flow, while it has double-digit growth potential from its international expansion plan for its restaurant brands. It currently offers a yield of about 3.3% that could increase as soon as next week when it reports its Q4 and 2019 results. Feeding into Restaurant Brands ingredients could be Nutrien's fertilizers. Nutrien is the world's biggest provider of crop inputs and services. It produces potash and nitrogen and also has a pretty stable retail business. Nutrien was born from the merger of Potash Corp and Agrium in January 2018. It has the financial resources to pay a dividend while buying back its undervalued shares. For example, its share count is about 6.7% lower than it was a year ago. Nutrien will continue to invest back heavily into the business. In the trailing 12 months, it used 52% of operating cash flow for capex, but it still managed to generate more than $1.5 billion of free cash flow, of which it paid out 65% for its dividend. It plans to maintain its investment-grade S&P credit rating of BBB. The undervalued stock has corrected about 18% in the past 12 months and is trading at about 18 times earnings with potential for double-digit growth. It currently provides a yield of about 4%. Simon Property is another company that you may know. You may have visited a Burger King or Popeye's that was in one of its malls. Unfortunately, Simon Property is in hot water. At least that's what people think by looking at its stock price action. The stock is trading 25% lower than a year ago and is in fact trading at an 8-year low. However, the U.S. retail REIT leader recently reported stable fundamentals for its 2019 results, despite the doom and gloom around the retail landscape. For its U.S. malls and premium outlets across 175 properties that make up the core of its portfolio, 79% of its net operating income, Simon Property reported retailer sales per square foot of $693, an increase of 4.8%, occupancy of 95%, base minimum rent per square foot of $54.59, and leasing spread per square foot of 7.83, which implies the likelihood of getting higher rental income on new leases. Additionally, its total net operating income, or NOI, growth was 1.7% for 2019. As Investopedia describes, net operating income equals all revenue from the properties minus all reasonably necessary operating expenses. So we want the NOI to be positive. Simon Property's funds from operations, or FFO per share, are also holding steady, falling only marginally by 0.7% in 2019 against 2018. The 2019 FFO per share of $12.04 equates to a payout ratio of 70%, which will be sustainable for the REIT as long as its FFO per share remains steady. Management expects growth to resume this year with a midpoint guidance that's 2.3% higher. Simon Property is awarded awarded a high S&P credit rating of A. It ended 2019 with a strong fixed charge coverage ratio of 5.3 times. Additionally, it's been able to reduce its weighted average interest rate over the last few years thanks to historically low interest rates. The stock is down because it's going through a period of slower growth, partly due to development and redevelopment activities that are needed for long-term growth. There's also the possibility that it'll take time to find new tenants for vacant spaces, which don't generate rental income until they're filled. However, thankfully, it appears there's high demand for the REIT's spaces, as the recent leasing spread was an increase of 14.4%. Thanks to the low stock price, Simon Property stock's dividend yield has been pushed up to about 6%, which is the highest it's been in the last 10 years. If you invest in these 3 undervalued dividend stocks, you can get an average yield of about 4.4% for passive income and above average total returns over the next few years. I'd greatly appreciate it if you can like or share the video if you found it useful. I'd also like to thank all the people and providers which allow me to put all this content together in this video. I hope I didn't miss any of you in the description. Please note that this video consists of my opinions and is for educational purposes only. Please do your own research and consult a financial advisor and a tax professional if necessary before making any investment decisions.